Good afternoon, everyone, and welcome back to another pipeline trading video. Happy July 4th weekend to all my Americans. Today, we're stepping away from the charts for a few minutes to discuss something much bigger than single stocks and crypto and the market index. We're going to talk today. This is a bonus video. I needed to do it. I'm not seeing a lot of coverage out there, and I'm seeing something I'm not sure most people are seeing or even really talking about. We're going to talk about the global financial system for a bit. Over the past few months, we've seen rising geopolitical tensions, increasing volatility in the commodity markets, stubborn inflation, and growing concerns surrounding government debt. Individually, none of these developments are unusual, okay? Markets have always experienced cycles. But when several of these forces begin moving together, then we create pressure that investors often fail to recognize until they already affect portfolios around the world. Hence why I've been talking so much lately about oil, and I've always pretty much talked about the 10-year, okay? So I want you to think of oil and the 10-year together as I go through this video, okay? One of the developments that recently caught my attention wasn't happening on Wall Street. It wasn't happening at the Federal Reserve, and it wasn't happening in the United States, to everyone's surprise. Where it's happening, or where I should say it happened, was in Turkey. And I know you're probably scratching your head saying, Turkey, what? Now, why should anyone investing in the S&P or Bitcoin or technology stocks care about Turkey and what's going on over there? The answer is because countries often reveal financial stress through their actions long before headlines begin talking about a crisis. And a few years ago, we had the whole yield thing in Japan that affected our markets. Okay, so you have to think outside the box here. Governments don't announce they're under pressure. Central banks rarely hold press conferences explaining they're running out of options. Instead, they quietly begin changing how they manage their reserves. Okay? They sell assets, they raise interest rates, they defend currencies, or they begin reducing positions they've held for years. Those decisions can tell us far more than political speeches ever will, and tuning into CNBC and Bloomberg and all of that jazz. Recently, Turkey dramatically reduced its holdings of US Treasury securities while also reducing portions of its gold reserves. And you heard me correct, they actually sold gold, okay, to buy oil. Now, before anyone jumps to conclusions, that doesn't automatically mean a financial collapse is coming. There are many reasons a country may rebalance its reserves. But what makes this situation worth discussing is the broader trend developing around the world. Turkey isn't the only country dealing with rising energy costs. Turkey isn't the only nation trying to protect its currency. And Turkey certainly isn't the only economy feeling the pressure from higher borrowing costs and slowing global growth. When we zoom out, we begin to see something much bigger. Countries that rely heavily on import energy are becoming increasingly vulnerable whenever oil prices climb. Trump warned Europe about this years ago. That matters. And I'm going to tell you why. Energy isn't just another commodity. Energy powers transportation. It powers manufacturing, agriculture, supply chain. Without affordable energy, almost every part of the global economy becomes expensive. And that's where today's story begins. Okay. So I'm going to tap in first. I'm going to go into, I have a lot of this stuff and I've been doing a lot of research. That's what I do while I'm trading or while I'm not trading. These are the things. I'm going to go into the world's financial plumbing. Most investors think about markets in terms of stocks. Others think about bonds. Others focus on real estate. Others prefer commodities and cryptocurrencies. But underneath all of those markets sits the financial plumbing that keeps money moving around the world. For decades, the US dollar has been at the center of that system. That was the world order that was agreed upon after World War II. International trade is largely priced in dollars. Oil is generally purchased using dollars. The petrodollar got off the gold reserve, right? Now, think about history. Oil is generally purchased using US dollars. Many countries borrow in dollars. Central banks hold large quantities of dollars denominated assets. Among those assets, none is more important than the US Treasury. That's what always happens, right? The 10-year is the big thing, which I've been warning about for the last few weeks that I'm seeing they could actually go a lot higher. Okay. They've been viewed as one of the safest financial instruments available. And I'm going to go into it. They're backed by the US government. They're highly liquid, widely accepted throughout the global financial system. That's why governments own them. They're not chasing massive returns. They're preserving reserves while maintaining liquidity. Okay. Think of them as the world's emergency savings account. Countries can sell their treasuries quickly whenever they need the cash. Most of the time, I should say, that system works incredibly well and has been for quite some time. But every financial system depends on one important assumption: there must always be buyers. If everyone wants to own treasuries, prices remain stable. If buyers disappear while sellers increase, okay, I'm going to repeat that. If buyers disappear while sellers increase, prices begin falling. Okay. And that's because bond prices and interest rates move in the opposite direction. Falling treasury prices mean higher yields. Most people don't know that. Higher yields may sound attractive for investors purchasing new bonds, but they also increase borrowing costs throughout the economy. Mortgage rates rise, corporate borrowing becomes more expensive, government interest expenses increase. That's a huge one, right? Especially when there's wars going on. You are borrowing at a higher interest. It's going to cost you nearly more than double what it would have to go to war 3, 4 years ago. Okay. Eventually, those higher financing costs begin slowing economic activity. So I hope it's starting to click on why this is such a big deal. This relationship between bond prices and yield is one of the most important concepts investors need to understand. Because while prices often receive all the attention, the bond market quietly influences almost every major asset class. Why oil changes everything, okay? Think about this one. Let's introduce another piece to this puzzle. I'm going to go into oil. Just oil right now. Imagine you're running a country that imports nearly all of its energy. Every month, your economy needs billions and billions of dollars worth of oil simply to keep businesses operating. If oil trades at $60 a barrel, your import bill is manageable. If oil suddenly climbs, okay, I'm going to go to the oil chart because this, if you remember, I've been saying this chop down eventually chops up. And when it breaks up, this measured move is going to take it back over 100, right? So if oil suddenly climbs to 90 or 100, okay, or 150, 200, don't think that that can't happen. Your costs increase dramatically. The problem is your economy doesn't instantly produce more dollars out of nowhere simply because energy became more expensive. You still have to pay those bills. So where does the money come from? Sometimes countries borrow, sometimes they draw from their foreign currency reserves. Sometimes they sell assets they've accumulated over many years. And that's where treasury holdings often become important. Selling treasuries provides immediate access to US dollars. Those dollars can be used to purchase energy, stabilize currency, meet other financial obligations. Again, selling reserves doesn't automatically signal panic. That's not what I'm trying to say here. This isn't a panic thing. It's something to just be aware of. Countries manage reserves all the time. That's a normal thing. The concern right now, from what we're seeing, develops when many countries begin facing the same pressures simultaneously. Okay, all at the same time. Because then you're no longer looking at an isolated decision. You're looking at a systematic trend. If numerous governments are selling treasuries at roughly the same time, the collective impact can be very meaningful and significant. More selling pressure leads to lower bond prices. Lower prices create higher yields. Higher yields tighten the entire financial condition globally. That's how stress begins spreading from one market into another. Not overnight, not through a dramatic headline, unless there's a black swan event or something, but gradually, quietly, almost unnoticed, until suddenly everyone begins asking why interest rates keep climbing despite central bank efforts. I thought interest rates would keep going down, right? That's what everybody wants. And everybody got really low rates during COVID and they think, oh, it's going to go back to those rates. Well, here's a lesson from history, okay? Anyone that knows me knows I love history. Some people hate that I talk about history and they find it boring, okay? But financial crisis rarely begin where most people expect. In 97, as an example, few investors believed Thailand would trigger the Asian financial crisis. Go look it up, go study it. In '08, relatively few people imagined problems with the US subprime mortgages. We all know how that ended. And let alone that one thing that was supposed to be isolated in America, guess what happened? It eventually threatened the entire global banking system around the world. The common theme is simple: stress usually appears first at the weakest points in the system. Those early warning signs often seem isolated until they aren't. No one knows what everyone's exposure is, but emerging markets all have the same type of exposure, some worse than others. That's why professional investors constantly monitor credit markets, sovereign debt, currencies, commodities, because by the time the stock market reacts, much of the underlying damage has already occurred. Play's already in, the big players have already caught it, and they have their moves, right? Today's environment may not develop into another financial crisis. In fact, it may simply represent another difficult period of adjustments as economic or as economies adapt to higher rates. Okay. And changing global trade patterns and whatever the new world order is going to be and how they structure that. Markets reward preparation, they rarely reward complacency. Okay. So remember that. And if you're wondering why emerging markets feel the pressure first, one of the biggest misconceptions of finance is that every country experiences economic stress at the same time. They don't. Financial stress usually moves in waves. It starts where balance sheets are weakest, where borrowing cost matters the most, where governments have the fewest options available. Like in Turkey, now they're selling gold to buy oil because they don't have treasuries to sell. They already sold them. That's why economists often watch emerging markets before they watch developed nations. Emerging economics generally have less financial flexibility, I guess is the best way of saying it. Many rely heavily on imported commodities like oil or natural gas or industrial metals or food. When commodity prices rise sharply, their trade deficits often widen almost immediately. At the same time, higher US interest rates make borrowing dollars much more expensive. Now imagine trying to buy more for energy while also paying more interest on your debt. That's a difficult combination for any country. The first response is usually simple. What do governments do? They begin using the reserves they accumulated over the years. Sometimes that's a foreign currency, as an example. Others, it's a treasury Sometimes it's gold. These assets are essential. They're essentially national savings accounts, which I said earlier. Okay. You don't want to touch them. But if maintained, your economy requires liquidity today. Those reserves become your first source of cash. And that's why reserves, you know, movements matter. They're often telling us where financial stress is building before the broader market notices. So, the cost of expensive energy, let's simplify it. Imagine your household has 500 every month on gasoline, electricity, and heating. Now, imagine those expenses suddenly double. Nothing else changes, not your income, your salary, nothing changes. It's the exact same. Okay, you have two choices: reduce your spending or begin selling assets like Michael Jackson. Okay, maybe you sell investments, maybe you refinance your debt. Countries operate under similar constraints. It's no different. Okay. Just bigger numbers and more responsibility and more at stake. Okay. The numbers are obviously much larger, but the principle here does not change. Higher energy costs force difficult decisions. The longer the costs remain elevated, the fewer options governments have to that they have available to them. Okay, they're limited. And here's what makes energy unique. Unlike many products, you can't simply stop buying it. Hospitals still need electricity, trucks still need diesel, airlines still need jet fuel, factories need power, agriculture still depends on the fuel and fertilizer. Like that's a huge one, fertilizer and the cost that it went up. Energy isn't optional, it's foundational. Understand how important and foundational it is to everything in our society. That's why prolonged increases in oil prices ripple through virtually every industry on earth, right? So I don't need to tell you that transportation becomes more expensive, shipping costs increases, manufacturing costs increases, food prices climb. Eventually consumers begin feeling inflation almost everywhere in their life, and that's the reason central banks are paying close attention to the commodity markets, right? So inflation creates a difficult choice. When inflation remains elevated, central banks often respond by rising interest rates. We're in a little bit of a pickle right now, guys, because debt is at the highest level it's ever been. Okay. So the goal is straightforward here: higher borrowing costs reduce your spending, which means you're taking liquidity out of the market and tightening. Reduced spending helps cool inflation. In theory, that sounds reasonable. Okay. In theory, in practice, it's much more complicated. Higher rates also increase financing costs for businesses. Home buyers face larger mortgage payments. Governments pay more interest on their debt, which America does not want right now, especially funding all these wars. Companies postpone expansion. Hiring slows. Economic growth weakens. Central banks constantly balance these competing risks, raise rates too aggressively, and you risk going into a recession. Keep rates too low, and inflation becomes entrenched in our society. That's the balancing act policymakers face today. It's really, we're in a very, very different and unique position globally right now, especially with the position of the debt that has continued to climb. It also is why markets react so strongly. If you notice recently, every time inflation reports or central bank meetings occur, investors aren't simply reacting to one number. They're trying to anticipate the next policy decision. Hence, why every time Trump said that the strait was open, it would run, and they close, or there's any conflict, it would go down, because everybody knows this. I'm going to give you a real. I gave you an example earlier, but here's another one for everyone, and it wasn't that long ago. Okay, this was a real world example in 2022. Okay, to understand how quickly financial conditions can deteriorate, it's worth looking at this. In 2022, Sri Lanka experienced one of the worst economic crises in its modern history. Several factories, uh, not factories, it's fun. Doing this long enough and reading long enough, you get a little brain fart, right? Several factors contributed. Tourism collapsed during the pandemic. Foreign currency reserves declined. Energy imports became increasingly difficult to finance. They couldn't do it. Inflation accelerated beyond anything they've ever imagined. Fuel shortages spread throughout the country. Long lines formed outside gas stations. Rolling blackouts became the norm during that time. They're very common. Food prices surged. Eventually, widespread protests erupted, if you remember. The crisis became so severe that the political leadership changed under extraordinary circumstances. If my memory serves me correct, I think he fled the country. Now, it's important to understand something. Sri Lanka's situation resulted from multiple economic challenges occurring at the same time. It wasn't caused by one single event, but it demonstrates an important principle that we talked about. Countries rarely experience financial crisis overnight. Pressure builds gradually, reserves decline, borrowing costs increase, currencies weaken, confidence erodes. Then eventually, like anything else, something breaks. That's why, as an investor, you need to pay attention to reserve levels, government debt, trade balance, and energy markets. Not to say that you're going to be able to fix or change anything, it's so that you're aware that you're aware of everything. They're searching, you should be, or if you look at any professional investor, they're searching for signs that pressure is building beneath the surface. Where is that pressure building? And what will be the effects if A, B, and C play out? And bond markets matter more than the stock market, which a lot of people don't realize. Okay. Professionals often spend just as much time watching the bond market, bond yields, than anything else, because the bond market significantly, and when I mean it's a lot larger than the stock market. It influences lending rates, corporate financing, mortgages, government budgets, bank profitability. Virtually everything financial and financial decisions depend on interest rates when it comes to businesses and the government and our homes with mortgages. So when Treasury yields rise sharply, money becomes more expensive. Companies refinance their debt at a higher cost, which is a problem, which even in Canada right now at the housing market, a lot of people are going to be refinancing their mortgages at a much higher rate, right? Now they're on fixed income. That's the issue. It's the same thing that's going on now with countries, just like in your home. If you have a mortgage, that's going to renew at a higher rate. Meanwhile, your income stayed the same. So what happens, right? Consumers borrow less. Real estate activity slows, which we're seeing all across Canada. It's picking up a bit now, but it's slowed a lot. Business investment declines. A lot of the banks' deal flows down. Economic growth begins cooling. That's one reason bond markets often lead the equity markets. They're reacting to change in financial conditions before corporate earnings fully reflect them. That's it. I'm going to repeat that one thing I just said. They react, okay, to the financial conditions before corporate earnings fully reflect them. Remember that. Think of bonds as the economy's heartbeat. Stocks are often the emotional reaction. Bonds tend to measure the underlying health of the financial system itself. So, could higher oil prices trigger another wave of inflation? That's the big question that investors are, and I should say investors, professional, retail, whoever it is, anybody paying attention to this, that's what they're trying to figure out. If energy prices remain elevated and inflation could prove much more persistent than markets currently expect. They already thought we'd be at 2% by now. That doesn't necessarily mean runaway inflation, but it does increase the probability that the central banks maintain a higher interest rate for a longer than investors hope. Right? Remember the whole saying I used to say: markets can be irrational longer than you could be Sullivan. It's the same thing. Okay. You know, does I'm trying to think of how to put this, but the thing is, does it does increase the probability that central banks will maintain a higher interest rate. That's what people don't believe right now. Markets have reportedly priced in aggressive rate cuts over the past several years. Many of those expectations have been pushed back now. Why? Because inflation has consistently remained more resilient than expected. Energy is one of the major reasons commodity prices don't simply affect gasoline overnight. They influence transportation, manufacturing, chemicals, plastics, all the stuff, right? It's a ripple effect throughout the economy. So, what should you be watching? Instead of reacting to the headlines, focus on the variables that actually drive the markets. Watch the oil prices. Keep an eye on this. I'm telling you, it's getting to a level that we're going to want to start to pay attention to start buying. Okay. Watch the yields. The yields right here, this is bullish consolidation. This is a bull flag. Okay. Can it break to the downside? Absolutely. It can fake everybody out. But remember, they only lower interest rates when something breaks. The only reason we got low rates during COVID was because the entire global economy shut down. Okay. Inflation, keep a close eye on that. Watch unemployment, watch the credit markets, watch corporate earnings. Most importantly, watch liquidity. Liquidity is what allows the financial markets to function smoothly. When liquidity is abundant, risk assets generally perform well. Remember that when they inject liquidity, like they did during COVID, the markets ripped. Everybody thought it was going to collapse. They injected $2 trillion into the market, low rates, boom, everything went up. But remember, that comes to an end too, because then they have to suck that out because of inflation concerns, which we all had. And a lot of people didn't really think much about it. And that's why we're in the position we are today. Liquidity is what allows the financial markets to function smoothly. Okay. Remember that. So when liquidity tightens, volatility increases. That's true whether you're talking about stocks, Bitcoin, real estate, or commodities. Liquidity is the fuel that powers the entire financial system. Okay. So now that we've connected the dots between the energy markets and the government debt and inflation and global liquidity, the obvious question becomes what happens next? Okay. And I promise you, I'm almost done. I'm getting to it. The honest answer is nobody knows. Anyone telling you that they know exactly what's going to happen in the next 6 months from now is guessing. Markets are incredibly complex. Politics change, wars end, central banks pivot, technology disrupts industries, right? I know that one very well, being in the venture capital markets for 15 years. One unexpected event can completely change the landscape overnight. That's why successful investors do not try to predict the future with certainty. They prepare for multiple outcomes. If you watch when I do my charts, I'm seeing, oh, is there a consolidation? What levels? Where can this go if I'm wrong? Where do I want to manage my risk? What type of play? What's my time horizon? What am I comfortable doing? What are the options looking like? They will tell you the story. There's also a guy I remember who used to gamble at the racetracks, and he never really cared about the horses. He always watched the board and the numbers because it's known for being a very um, fixed, I guess is the best way. There's a lot of corruption in the horse gambling world. Uh, a lot of the races are fixed. So he only cared about watching the numbers and seeing where the money was and at what time the money was coming in, because the big money usually comes to the back end, so nobody sees their move. They don't do it at the beginning. Think of that, right? So instead of asking what will happen, a better question is, if this happens, how should I respond? That's a much more useful framework that I go off of. The dollar isn't going away tomorrow. So anybody, when they talk about de-dollarization and all that stuff, that will take a lot of time. There's swap lines that America has with almost 90% of the countries that would owe them money that they couldn't pay, because this has been incurring interest and interest and interest over the last 30 years. So that is not going to happen overnight. And personally, I don't believe that's likely anytime soon. The US dollar remains the world's reserve currency for a reason. It has the deepest capital markets, the largest bond market, the most liquidity, or I guess you could say the most liquid financial system. And despite its problems, which all countries have, investors still view it as one of the most safest places to park capital during periods of uncertainty. That's incredibly difficult to replace. And the reserve currencies do not disappear overnight. You can look in history with, the last one was Britain. Okay. That did not happen overnight. So history shows us they fade over decades, not weeks, not months, not, we're talking decades. Look at the British pound, didn't lose its status in a single year. Okay. Neither did the previous reserve currencies throughout history. These transitions happen slowly. Global trade evolves, economic power shift, new alliances form, technology changes. Eventually, another system emerges where nowhere near knowing exactly what that next system looks like. Could it involve multiple reserve currencies? Possibly. Like, that's the most logical thing. Could a digital asset play a large role? Maybe. Could central bank digital currencies become more important? That's certainly being discussed around the world. Um, Look at Larry Fink and all these guys with BlackRock and now the World Economic Forum, and talking about digitizing everything and having everything on the blockchain and blah, blah, blah. There's a very good possibility it will be a part of the system. How much? Nobody knows, right? That's exactly why diversification matters, knowing what weight you should be in and what sectors at what time, rolling into different things, right? And why I was talking about right now, you had the chips, software's been lagging, crypto's lagging with software, things rotate at different times. Through, hard assets continue to matter. That's throughout history. Periods of elevated inflation have generally benefited real estate more than financial assets. Think about what inflation actually is. This is another thing people don't realize. It is the purchasing power of money declining over time. When that happens, people naturally begin looking for assets that tend to maintain purchasing power. That doesn't mean they're guaranteed to outperform. Nothing is guaranteed, but history gives us clues. Gold has served as a store of value for thousands of years. They call it God's money. Energy remains essential regardless of economic cycles. Copper, natural gas, agriculture, any commodities in agriculture. These are all resources the world needs, whether markets are bullish or bearish. Even quality businesses with strong cash flow, like take that out of Warren Buffett, right? And pricing power can perform well over long periods because they have the ability to adjust prices as inflation changes. The common thread isn't speculation, it's ownership of productive assets. Assets that generate value, produce something, or provide a service society depends on. So, where does Bitcoin fit in this? Okay. As many of you know, we've discussed Bitcoin numerous times here on Pipeline. Okay. And we look at this and, you know, we're gonna find out. Some investors, view Bitcoin as a digital gold. Others see it as a speculative technology. The truth is, it's probably a bit of both. Bitcoin is still relatively young compared to traditional financial assets. It's specifically more volatile than gold, but its fixed supply makes it unique. So, unlike a fiat currency, and by the way, the fiat system goes to zero no matter what. And if you don't believe me, go look in history. It happened in every country throughout history that had a fiat currency. Okay? Anybody who loves reading, read a book called The Creature of Jackal Island, and you will see how in America they fought the Federal Reserve from having a fiat currency for so long. Okay. So these are things to that will teach you about history that will make sense on the plumbing of the financial system, right? So unlike fiat currency, no central bank can create more Bitcoin. That's why the bankers are fighting the Clarity Act so much, because they're going to lose yield. For investors who believe governments will continue expanding money supply over time and keep the printers on, if they lower rates, guess what happens? More money circulates in the market. Uh, Bitcoin, if they do that, becomes an attractive characteristic. Does it mean Bitcoin is guaranteed to outperform? Absolutely not. It remains a high volatile asset. Position sizing matters. I've talked about that, and risk management, time horizon. Every investor needs to understand those risks before investing. So, why risk management always wins? If you've watched this channel for any length of time, I know I do longer videos. It's because I'm trying to explain everything. I don't want to just put it out there and have people not understand why I'm saying what I'm saying. So it might be boring, but if you listen and you go through the whole video and you look at the charts and you look at what I've drawn in, I don't even do it now in real time, most of it. I put everything out. You could take a screenshot and you can monitor it and see am I full of crap or not? Is it working or not? Right? So, my philosophy. Charts matter. Technical analysis matters. Fundamentals matter. Macroeconomics matter to me. All of these things do, but none of it matters if you ignore risk management. So, the best investors in the world are wrong regularly. The difference is they manage their risk. They don't bet everything on one outcome, which I've talked about many times. They don't chase a headline. They don't panic during a correction, and they don't become euphoric during a rally. They follow a process. That's exactly what we're trying to do here. Whether you're analyzing the S&P, what I do with Ethereum and Bitcoin and BMNR, oil, everything that I do, whether it's Bitcoin, Ethereum, or BMNR, or Tesla, or the yields, the same thing can be applied to every single stock, every commodity, even the currencies, on how I chart things and what I'm looking at. Okay. The goal isn't perfection. The goal is stacking probabilities in our favor while protecting and preserving our capital. So the bigger picture is when you step back, the global economy is always evolving. Okay, it never stays the same. There's some periods that are driven by technology, others demographics, others by debt. Right now, we're living through an environment where interest rates, inflation, government debt, geopolitical tensions, and energy markets are all interacting at the same time. That creates a lot of uncertainty, and the markets do not like uncertainty. But uncertainty also creates opportunity. Some companies are going to struggle, others will thrive. Some sectors will outperform, others may become leaders over the next decade. Our job isn't to react to emotion. Our job is to identify trends before they're obvious. That's why we study macroeconomics, not because we can predict every move, but because understanding the bigger picture helps us make a better decision. It's that simple. So, what I'll be watching over the coming months, these are all indicators I'll continue to watch closely. Okay. First, oil. Energy influences nearly every part of the global economy. Second, I'm going to watch the US Treasury market. Yields tell us tremendous amount about financial conditions. Third, I'm going to watch the inflation data, not just the headline CPI, but core inflation and wage growth. That's very important. Fourth, the credit markets, because credit stress often appears before the equities fully react. Remember that. Credit stress appears before equity markets fully react. And fifth is liquidity, the biggest driver of them all. Liquidity drives markets. When liquidity expands, risk assets generally benefit. When liquidity contracts, volatility usually follows. And finally, corporate earnings. At the end of the day, stock prices eventually follow earnings. Everything else is noise, right? Final thoughts. Is Turkey the beginning of something much larger? Maybe, maybe not. You know, one thing to keep in mind too is the US oil reserves is the lowest it's ever been. So America is not importing oil, they're exporting oil. So think of all the emerging markets, okay, that are importing oil, that do not export, only import. So maybe, maybe not. Only time will answer that question. What matters is paying attention to the signals. Without being consumed by fear, markets have always climbed walls of worry. They've survived wars, inflation, financial crisis, political uncertainty like we've experienced since 2016, and countless predictions of collapse. Some predictions prove accurate, many don't. Even when there's a collapse, we've had V shaped recoveries. It wasn't the end of the world, right? But the fear mongering is what got people, and they sold. Some bought. Those are where the opportunities will remain. That's why disciplined investing always beats emotional investing. Stay diversified, manage your risk, focus on quality, think long term, don't be short term, and most importantly, continue to learn. If you're not learning, it's not going to help you. A lot of people think they're educated and I got this degree. They don't got any degree. Okay. They're sheep. That's what happens because they stop learning. So it's great that you read a book and got a degree. What are you doing with it? Are you putting it into action? Because educating yourself it never ends. And it shouldn't end. It can't end because the world's always evolving. So unless you're learning and staying up to date, you're going to have a problem. Your degree is going to mean nothing. Plenty of people I know that had degrees in economics and done nothing with it. Okay. Same in finance. It's a degree, it's a tool. It's great. You learn, it's a foundation. Build off of it. Never stop learning. Because the more you understand how the global financial system works, the less likely you are to be surprised when the markets become volatile. So, if you found today's breakdown helpful, please let me know your thoughts in the comments below. Okay? Do you believe rising energy prices could create broader financial stress? That's one I want you to put in there. Yes or no? Or do you think the markets is overestimating those risks? I love to hear your perspective. If you've enjoyed this video, please don't forget to like, subscribe, and hit the notification bell or whatever it is so you never miss my latest video analysis. And like I always say, stay disciplined, trade with intention, and God bless you all. Have a great 4th of July weekend.